Hi everyone, happy 7-Eleven day. Have you ever wondered what is your desired rate of return? What is a good return and what is a bad return? Let's start with the simple definition. Rate of return simply means the percentage of your money that you get from putting into investments. Everyone wants high return, right? In this case, we make three assumptions. First is consider that we have already set aside sufficient emergency funds worth 6 months of expenses. Second assumption is that we are looking at the passive return of our extra money, excluding the active investing or business profit. And third assumption, we are looking at Singapore context. Let's understand a bit on the concept of interest rate. Why everyone concerned about US interest rate? Of course, USA is the world's largest economy in terms of GDP. When the Federal Reserve increased the interest rate, the other countries' central banks will also follow the same. In Singapore, the central bank is MAS, Monetary Authority of Singapore. It is owned by the government. It has the power to increase or decrease the interest rate, which we call the monetary policy. The purpose is to ensure Singapore economy is growing steadily, not too much of the inflationary pressure. Why we focus so much on the country interest rate? Because it affects directly the cost of borrowing of the banks. If the central bank increase the interest rate, it also means the banks have to pay more for their borrowing, and the effect will drive down to the consumers like us. If the banks like DBS, UOB, OCBC can borrow cheap money, we can also borrow cheap, or vice versa. In short, the country interest rate affects the return of the bank. There are two types of interest rate. First one is the interest rate that the bank charge on borrowings, such as housing loan, credit card, business loan, and personal loan. And the second one is the interest rate that the bank offers on deposits, such as your saving account and fixed deposit. What are the passive ways where most people put their money in? Other than return, we should also look into the liquidity risk, meaning the flexibility to withdraw the money and the barrier to get it, such as the minimum required sum of money. First, bank saving account. Everyone should have at least bank saving account for your salary crediting or for your daily use. The return. The saving account base interest rate is just 0.05%. If you could satisfy some of the criteria such as salary crediting, spending certain amount and growing the saving, you may be entitled to up to 0.7% bonus interest rate in your account. There is no liquidity risk because you can withdraw the money anytime you want. The most is that we lose the bonus interest rate, which is just less than 1%. The barrier, the minimum required sum is likely about $1,000 to open a bank account. Do check out the minimum required balance to maintain, which varies from bank to bank. If you are unable to keep the minimum balance, the bank will deduct maybe around $5 from your account monthly. Second, fixed deposit. This is a facility offered by the bank to encourage us to keep our saving in the bank for a specific tenure. The return is up to 2%. There is low liquidity risk even though there is a lock-in period which we commit. For example, could be up to 12 months, 24 months or 36 months. However, if we really need the money, we can make the withdrawal. We can still do so and we will lose the interest rate, which is just 2%. There is minimum deposit amount required, varies from banks to bank. Some might need just $5,000, some might require up to $30,000. Third, Singapore saving bond. The average return is up to 3% for a 10 years duration. Interest rates step up and payable every semi-annually. The interest rate for SSB changes every month. For monthly update, do check out the MAS website for the interest rate update. Link in the description below. This consider risk-free saving instrument fully backed by the Singapore government. SSB is only open for individual aged 18 years and above. Investment amount ranging from minimum $500 to a maximum $200,000. There is low liquidity risk. If you wish to exceed the SSB after 1 year, you can do so. Do remember this is based on the step-up interest rate, meaning in year 1 you will only get 2% interest only. The fourth one, Singapore dividend stock. The return varies depending which stock you own. Historically, Singapore blue chip stock offer dividend ranging from 1+% up to 6%. The average return is probably 3 to 4%. There is low liquidity risk if you buy the stock using your own brokerage account. For my case, I am using MooMoo account to keep some REITs and bank stocks. which I can withdraw by selling the stock and make withdrawal from the account, probably just one business day. There is risk of losing money. Stock investment doesn't guarantee the return rate. If the company performs well in the year, they may declare to distribute higher dividend yield to the investor. What is the barrier? To open a brokerage account, you need to be at least 18 years and above. If you are not from accounting or financial education or profession background, you would need to complete a customer account review, CKA, which you can study and then take the test. Minimum investment units is 100 stock, so depends on the stock price. If the stock price is just $1, then the minimum investment amount is $100. Fifth, Singapore Central Provident Fund, CPF. All Singaporean and PR must be very familiar with CPF. We are not getting the full salary. 20% of our monthly salary is kept with CPF to keep growing for our retirement. The interest rate for special account and MediSave account is 4% per annum. Interest rate for ordinary account is 3.5% on the first 20,000 and then 2.5% thereafter. The 4% interest rate is derived by adding the 1% on top of the return from the Singapore saving bond, which is averaged to 3% per annum for the 10 years tenure. Do note that the interest rate of CPF may also change from time to time. What are the risks? CPF, of course, is a risk-free investment backed by the Singapore government. No one can escape from CPF contribution. If you are salaryman, your company will do it for you. The barrier to withdraw is high. We cannot withdraw the CPF until the age of 55. We can withdraw from OA account for some specific usage, such as to buy house, to buy stocks if you have minimum balance in the OA account, or maybe for education of your child. For SA account, there is no way to withdraw before reaching 55 years old. Some people who wish to earn the extra 1.5% interest rate, they transfer the amount from OA to SA account, and the barrier to withdraw is high for SA compared to OA. So we know the interest rate from these few options. What is a good rate of return? For passive investor, a good rate of return should be higher than the risk-free rate, which is currently 4% based on the CPF SA account interest rate. In terms of return, some dividend stock offer higher than 4% return, which is definitely more attractive, along with the flexibility to withdraw, but do come with the risk of losing money. In terms of risk, saving accounts, fixed deposit, Singapore saving bonds and CPF are having close to zero risk. If we compare the return, the lowest return is saving account, followed by FD, SSB and CPF. And of course, the barrier to withdraw is also increasing. You can diversify your safety net in those various risk-free options. But if you are looking at good rate of return, stock investment offer low barrier to get in and the flexibility to withdraw. So if you haven't reached your retirement age, it is still not too late to start investing in stock. The assumptions for comparison in this video are based on Singapore context. In reality, there are various stock markets available such as USA, Australia, Hong Kong or China market. Again, do invest within our circle of competence. Be patient and start small. Let's aim for higher rate of return with minimal risk. Do comment below if you have any opinion on this. Thank you for watching this. We'll see you in the next one.